John K., Other People's Money, The Real Business of Finance. Dive into the world of finance and uncover the fundamentals and complexities of the global financial system with this summary of the book Other People's Money, The Real Business of Finance by John K. Throughout this book's summary, you will gain an understanding of how this system began as a mutually beneficial way to conduct business, and has since evolved into a tumultuous and oftentimes harmful apparatus. You'll witness how rampant financialization, corporate greed, enhanced technology, and lax regulations have led us to the financial crisis of 2008. Moreover, you'll explore the role of government bailouts, lobbying, and the public's lack of understanding of this convoluted industry.
Finance, a blessing and a curse. Finance was invented to improve our quality of life, help us conduct business, own property, and organize assets. A healthy financial system can benefit society, but capitalist freedom has led to financial innovations that are not always beneficial to us. The financial industry has lost sight of what's good and bad for the global population as a whole, and this summary will delve into why this has occurred. The danger of financialization. Financialization, the rampant trading activity and massive growth in the finance sector, has not had any positive impact on household income or small business growth. The emergence of derivatives, such as credit default swaps, has led to artificial inflation and ultimately contributed to the 2008 financial crisis. Financialization is akin to gambling and is not beneficial to anyone. Rewritten. Gone are the days when finance existed to help people realize their ideas. Nowadays, the finance sector is drowning in needless transactions that serve no purpose. This is due to financialization, the rampant trading activity that has helped banks and stock markets but has had no positive impact on household income or small business growth. This trend started in the 1970s when large institutions began trading in securities, which are financial assets such as stocks, bonds, and mutual funds. However, the real trigger for financialization was the emergence of derivatives, which are contracts that base their value on how well other assets perform. One example of a derivative is a credit default swap, CDS, which allows a bank to protect itself against a borrower defaulting on their loan or mortgage. But this can quickly turn dangerous as too many institutions invest in CDS. This is what happened in the 2008 financial crisis. Too many banks gave loans to people who were unable to honor them, and multiple people defaulted on their loans. The system collapsed upon itself. The financial crisis was escalated by technology that made trading securities and derivatives easier than ever, leading to massive artificial inflation of the financial sector. Such practices are akin to gambling, which isn't beneficial to anyone. It's important to remember that finance should help people realize their ideas, not drown in needless transactions. Financialization and the volatile economy. The finance sector's culture of risk-taking and short-term gains has led to a less stable economy. In the past, banking executives had a personal investment in their banks, leading to more caution and reliable decision-making. However, in the era of financialization, executives prioritize short-term gains and do not act in the best interests of their banks. This has resulted in granting mortgages to unreliable borrowers and brokers making deals that benefit themselves over their clients. In the past, the financial sector promoted a culture of caution and planning, leading to a more stable economy. This was due to executives investing their personal funds into their banks, giving them a personal stake in avoiding failure and risky decisions. However, the era of financialization has resulted in a more volatile economy, as executives prioritize short-term gains and are not incentivized to act in their bank's best interests. This has led to the granting of mortgages to unreliable borrowers, contributing to the financial crisis of 2008. Additionally, the shift towards broker-dealers making their own deals has led to conflicts of interest, as brokers prioritize their own profits over their clients' best interests. The root cause of the global financial crisis. The 2008 global financial crisis was not an unforeseeable disaster, but rather a predictable outcome resulting from years of risky and selfish decisions made by bankers driven by insatiable greed. The shift from private to corporate ownership of banks allowed executives to take greater risks with shareholders' money while being unaccountable for any losses incurred. The dangerous practices of mortgage-backed securities and credit default swaps only added to the destabilization of the financial sector. The crisis was caused by the offering of mortgages to people who could not afford them and the trading of securities based on those mortgages, leading to both banks' inevitable downfall and subsequent bailouts by national governments. Finance's political influence. Banks, with their vast resources, exploit their political power to influence legislation. The financial sector spends more money on lobbying than any other industry. The U.S. finance sector spent $800 million between 2012 and 2014. This spending creates dependency and banks expect favors in return. The 2008 crisis showed how much influence the financial sector has on the U.S. government. The banks financed subprime mortgages, knowing that taxpayers would be left with the bill. It is difficult for the average person to understand complex financial deals, making it easy for banks to take advantage of their customers. The finance industry has a history of making risky and irrational decisions yet are never held accountable for their actions. The two sides of financial regulations. Financial regulations can both protect and harm the industry and consumers. Excessive regulations can lead to more work for the authorities and encourage institutions to find ways around them. It can also make finance more complicated, leaving average customers vulnerable to exploitation. However, regulations can also provide transparency and protect consumers if implemented effectively. There is a need to strike a balance between protecting the industry and ensuring that it serves the best interests of its customers. The creation of international regulations is a possible solution. The Securities and Exchange Commission, SEC, oversees financial regulations in the U.S., but jargon-filled information can result in outsiders being kept in the dark. Restoring trust in the financial sector. As politics become more divisive, it's crucial to prevent the financial sector from making profits through shady deals that cost hardworking people their life savings and require government bailouts. To prevent another crisis, the financial sector must be restructured. One crucial step involves removing the temptation for professionals to act in their own self-interest over their clients. This can be done by better separating jobs within the financial system, so brokers would only be rewarded for negotiating successful deals and prohibited from arranging self-serving financial transactions. Additionally, people's savings deposits must be protected and kept off limits from banks and other financial trading institutions. By promoting proper ethical conduct from within, the financial sector can instill ethical business practices, and executives and leaders can set a good example by rewarding those who adhere to similarly ethical practices. Though the transformation won't be easy, it's essential to start somewhere to restore trust in the financial sector.
As we conclude this overview of Other People's Money, the Real Business of Finance, remember that finance was originally created to enhance our lives and facilitate business. However, due to greed, complex financial mechanisms, and a lack of ethical conduct, the financial system has deviated from this beneficial role and led to crises with lasting effects. To mitigate the risks of future catastrophes, it is essential to ensure regulatory organizations, ethical practices, and transparency. Additionally, restoring trust within the financial industry should be a top priority. By understanding the intricacies and historical context of the financial world, we can better anticipate and navigate the challenges and limitations that this ever-changing landscape presents.